Hey there, lovely folks! Welcome back to another enlightening episode of our podcast, where we decode the complex world of finance with a touch of flair and a sprinkle of wit. Today, we're diving deep into the ocean of commercial real estate to unravel the mysteries of the capitalization rate. Imagine you're an explorer navigating the vast, unpredictable seas of commercial real estate investment. Amidst the waves of information and the storms of uncertainty, what you need is a reliable compass. That's where the capitalization rate, or cap rate, comes into play. The cap rate is a simple yet powerful tool that can guide your investment decisions. It's calculated by dividing a property's net operating income by its current market value. This ratio gives you an estimate of the potential return on an investment property. Picture it as a compass pointing towards the direction of potential returns. But just as a compass isn't the only tool needed to navigate the open seas, the cap rate isn't the only metric you should consider when investing in real estate. It's one piece of the puzzle, a part of the bigger picture. It doesn't account for factors such as leverage, the time value of money, or future cash flows from property improvements. Let's paint a more vivid picture. Consider yourself on a treasure hunt, and the cap rate is your treasure map. It guides you towards the potential hidden gems in the world of real estate. But remember, a map isn't much good if you don't consider the terrain or the weather conditions, right? Similarly, the cap rate is a starting point, but it's not the end-all be-all of real estate investing. So, what's the takeaway from all this? The capitalization rate is a valuable tool in your real estate investment toolkit. It can guide you towards potential returns, but it doesn't tell the whole story. It's a starting point, a compass to help you navigate the vast ocean of commercial real estate. The capitalization rate, or cap rate for short, is like your trusty compass in the vast sea of investment options. It's the rate of return expected from a real estate investment property, calculated by dividing the property's net operating income by its current market value. Think of it as your guiding star in the world of real estate investing. Now let's break it down, shall we? Imagine you're on a treasure hunt, searching for that elusive chest of gold. The capitalization rate is like your treasure map, guiding you to that hidden fortune by assessing the property's intrinsic rate of return. It's your ticket to unlocking the secrets of real estate investing. But as with all treasure hunts, there's a twist. You see, the capitalization rate is all about finding the perfect balance between risk and reward. It's like walking a tightrope, where a misstep on either side could lead to a fall. On one side of this tightrope, we have the higher cap rate. Now, this might sound attractive at first glance. After all, who doesn't love the promise of higher returns? But just like a pirate's life isn't all fun and games, a higher cap rate comes with its fair share of risks. It might indicate that the property is in a less desirable area or that it requires substantial improvements. These factors could potentially affect the stability of your returns and increase the risk of your investment. On the other side of the tightrope, we have the lower cap rate. This is the safer side, where the waters are calm and the winds are gentle. A lower cap rate typically indicates a more stable and secure investment. But as with all safe options, the potential for high returns isn't as great. It may take a longer timeline to recoup your investment and start seeing significant profits. So, how do you walk this tightrope? How do you balance the promise of high returns with the need for security and stability? That's where your financial acumen and investment strategy come into play. You need to assess your risk tolerance, your investment goals, and your timeline to determine the right cap rate for you. Remember, the capitalization rate is just one tool in your investment toolbox. It's essential, but it doesn't paint the whole picture. You need to consider other factors like the property's location, its condition, and the current market trends to make an informed decision. So the next time you're venturing into the realm of commercial real estate, remember to keep your eyes on the prize and your cap rate in check. With the right balance of risk and reward, you'll be sailing towards financial success in no time.